rather than sort of talk about Disney now and then talk about it again, I thought I'd tell you about a stock that I think is interesting and we haven't talked about much, or indeed possibly at all, on this show. Stock I'm looking at the moment is a company called Halma. They're listed on the UK Stock Exchange, they're in the FTSE, and they're in the FTSE 100. So there's a FTSE 100 stock. Not many of those going around that we like very much, but I do like this one very much. I think Paul will as well when he gets round to looking at this, if he gets round to looking at it. It has a dividend that's growing, and it's been growing for the last 42 years. It's been growing by about 5%. It's reached a mighty 0.82% at the moment, so probably it's unlikely to outpace inflation just on the dividend, but it's growing fairly well, and if inflation comes down, that growth might outpace inflation, I suppose. Anyway, on to the stuff that the rest of us care about. So what is this company? And to be honest, one of the reasons I haven't talked about this sooner on the show is because I haven't really been able to work out the answer in a fashion that I was happy repeating, because I could read out a bunch of words without really knowing what they mean, but I'm not going to do that. And so far when I've looked at Halma, it's always been, okay, that's a bunch of words, I know what they mean individually, and I'm struggling to get a feel for what they mean when they're put together. But I think I've roughly got it, basically. So Halma is a conglomerate. It's a bunch of small businesses. There isn't really a kind of central organising thing. You might kind of loosely compare this to Berkshire Hathaway, which I'll do at a time, but here's one important difference to get us going. Berkshire Hathaway, you can think of what their kind of big pillars are. They have the railroad, they have the energy stuff, they have the insurance stuff, they have a pretty big Apple holding and so on. And those are the four kind of clear big businesses that that power them along, basically. Halma is not quite like that. It's made up of about 45 different businesses, and none of them is that big as compared to the whole thing. But they divide themselves up into basically three segments. Each of these has kind of clusters of businesses in them. There's safety, there's environment and analysis, and there's medical. So they consider themselves to be a life-saving tech company, or a life-saving tech conglomerate, I suppose. So just a little bit on what each of those segments is about, because they're kind of nice names that don't really tell you an awful lot. The first segment was safety, which is about 42% of revenues. That's growing at 16%, roughly, which is kind of nice. And that deals with stuff like fire detection and extinguishing, pressure management in industrial pipes, and sensing solutions for people moving around in industrial settings, so labs and factories and those kind of things. And what they basically do is acquire small businesses. They've recently acquired one called Ramtech, which is a decent example of the kind of company that they have. Ramtech is a wireless fire detection system outfit. They're very, very small. Apparently wired fire systems can be slow and hard to install and difficult to fit if the building isn't the way you thought it was. And there's a real drive towards wireless fire detection sort of stuff for buildings. So Ramtech is a company that they've kind of plugged in as their latest acquisition there. Their environment segment is 29% of revenues. That's growing at about 24%, which is a decent clip, really, for revenues, to be honest. They deal in things like spectral imaging systems, water analysis and treatment, and gas detection. So loads of environmental techie things to do with making water cleaner, getting clear on what's polluting various things, and so on and so forth. Their most recent acquisition there is Minicam Group, which is a company that works on relining wastewater pipes. Basically what that means is, if you think about the sewage system in London, that's basically goes back to Victorian times, I think, and relining pipes as they wear out is hard work. Usually that would involve digging them out of the ground. Minicam has an operation where they can basically push stuff down the pipes and have it reseal them from the inside, which is more efficient than trying to dig through the ground and pull the pipes back out and reseal them like that. So another nice innovative thing. And the third segment is the medical segment. That's another 29% of group revenues. If you're keeping track, that is all of it. And this is growing at about 33%, which is a pretty good clip. So they're interested in things like in vitro diagnostics, which is, roughly speaking, pregnancy monitoring. And they're also interested in kind of other monitoring systems and components for monitoring systems. So Suntech is their most recent company there. What they make is a kind of motion-tolerant blood pressure monitoring thing. So you can attach a blood pressure monitor to someone and have them go about their day rather than sitting in a hospital or a doctor's office waiting while their blood pressure gets monitored. That outfit's looking to kind of expand its reach beyond its current range, and plugging it into Halma's big conglomerate with lots of overarching stuff and reach and range is helpful to them. So, okay, that's roughly what it does. You've got a bunch of small businesses that all work together in this kind of way. How do we think about this as investors, I guess? Well, having that many businesses that are all small means that we are pretty hugely diversified, right? So if any one of these goes wrong, it's not going to knock a big lump out of anything. 45 businesses in total. I've written down that it reduces risk. I guess it reduces the risk of any single business. And they have had some businesses go wrong, but it doesn't break the whole system if something, one of their smaller businesses kind of goes and gets disrupted or displaced. Their kind of moat comes from, and you hear this a lot from me, but focusing on niche markets and things like that. So small markets makes them hard to disrupt, disincentivizes anyone from spending much money to come and break them up because they have a sticky kind of dominant position in lots of things like wireless monitoring and so on. It would cost a lot to replace them and you wouldn't get a lot back once you did. And by picking up loads and loads of these that focus on these kind of things, they tend to try and make themselves a fairly robust kind of business. The downside to this is that niche markets are niche. There isn't huge amounts of room for growth in any of these kind of markets. So you need to keep adding businesses and you need to keep looking for kind of inorganic growth. So organic growth is what you get by just basically selling either more of the same stuff or selling it at a higher price. Inorganic growth is what you get by adding something else to your business, one way or another, usually by acquiring something. And growth by acquisition is always risky, right? I mean, you've heard us talking about Teladoc recently. If you pay the wrong price for something, it can go very wrong and it can hammer your business. So that's a risk with Halma because that's how they plan on growing, at least in a decent amount. They talk about kind of organic growth from niche markets, and there is some, that's definitely true. But their main thing that's going to push them along is by adding businesses, and they've been acquisitive in the last couple of years in quite a busy way, which is kind of nice to see with companies selling cheap. So there's risk there, and there's also a changing guard at the top. Andrew Williams has been their CEO, done a really good job. He's being replaced by their chief financial officer. Does he have the same skills? I couldn't tell you. I mean, he's from inside the business. He understands it very well. There's a culture there that he will understand and so on. But I guess there's a bit of a question mark over exactly how well they'll acquire in the future. If your business depends on you acquiring well, a change in the guard always brings a kind of possibility of things going less well than they have done. Could also go better, of course. Growth by acquisition and talking about comparing them to Berkshire, size kind of can become an issue here. So Berkshire, one of the issues is that once they've done their acquiring, they now struggle to find things that are big enough to move the needle. Because Buffett's always saying there's no point in looking for a few $100 million of acquisition here. It won't make a meaningful difference. That's not quite there for Halma yet. They have an 8 billion market cap. There's plenty of things you can buy that will make a difference, but not a huge difference to your 8 billion market cap. Your kind of universe is wider. There's plenty more things they can find, and they do continue to find things that are pretty good to kind of buy. Again, I'm kind of comparing them to Berkshire a little bit. They have a nice decentralized structure, right? So there's no one at headquarters whose job is to oversee the safety stuff and the healthcare stuff and the environment stuff, because it's hard to see anyone's circle of competence being that big. But what they do that I think Berkshire don't, actually, which is slightly surprising to me, is get their individual CEOs to talk to each other and work together and collaborate quite a lot. Berkshire don't do this. So Dairy Queen quite famously didn't accept American Express for quite some time. And Dairy Queen being a wholly owned Berkshire subsidiary, American Express being a big investment they have. And you would think it made quite a lot of sense for someone to just lean on Dairy Queen and say, look, we could do with stuff going through American Express, maybe only accept American Express, make people use these damn cards if they want to eat in Dairy Queen. But central office always resisted the kind of temptation to do that and said, yeah, we're not going to kind of make them do these things. Our individual CEOs run their own businesses. And that's true at Halma as well. But it is also kind of the case that they're supposed to work together. There's a reason they're in these kind of segments where they're in similar things like gas detection and smoke detection and process safety and that kind of thing. Because the thought is they can plug in and work well together. So this is a business I like a lot. The stock's done really, really well over the last few years. Returns on invested capital are great. Balance sheet looks pretty good. It's got everything I like as a business, basically. I think it's got a fairly good moat too, and it's in an area that doesn't get a huge amount of press from what I can see of it. And I like things that are kind of, I want to say under the radar, but under the radar is a kind of slightly cliche term. But I like things that not everyone's talking about and you get huge amounts of attention on the stock. Unfortunately for me, here's the downside, and here's why it's a watch list one rather than a buying one. This is kind of expensive, I think, at the moment. It's growing at a pretty good clip. It's been growing at 10% over the last 10 years or so, but it's got I guess it's got, I want to say a problem with how much free cash it throws off. But in fairness, it's not the company's problem. I think the problem is the stock, not the business. So it's got an 8 and a bit billion market cap, 8 and not very much. 432 million in debt, 157 million in cash. And the free cash flow yield on that gets you to just under 3%. Company's growing well, has shown a good capacity to grow well, keeps growing well. Eventually, and I think there's a good runway still for growth there, right? At that size, I think you can acquire plenty more things and keep moving yourself forward. The trouble is they really need to at these kind of levels from what I can see of it, and maybe they can, but when I'm looking for the kind of margin of safety thing, it feels like it's not quite there for me at these prices. I'm looking for it around the, I think, somewhere under 20 quid mark. I think it's probably about 23 or 21 or something like that at the moment, so just looking for a little bit more before I get into this. And by the time we get to Sunday, it might be at that level already, right? I mean, if the US bank earnings decide to destroy the market, we're recording this part of the show on a Wednesday. You might have to edit that bit out. Never mind. If the market goes down significantly between now and Sunday, it might be there. But it does look to me a bit like this is kind of on the expensive side for what I'd like to buy at the moment. But it's a good company. I feel like I missed my moment a little bit on this by not being fast enough with the research. The announcement there's a change in CEO coming pushed the stock down because it often does. And I think probably then it hit a level I would have been interested in it at. But right now, a bit too high. Moment might have passed me there.
What you need is the wrong CEO to come in. We saw that at another company we really like, which I suppose we can make big comparisons. This one in Diploma. Diploma is another sort of mini conglomerate. It trades just as rich. But when they changed their CEO, it was a long-standing CEO. I think he retired, did he not, Steve, off the top of my head?
That's a good question. I'm not sure about that one.
Yeah, I think he did. But the person they brought in, who initially looked like a brilliant fit, just ended up not fitting. Diploma has a very good way of making all of its subsidiaries talk to each other but whilst leaving them to manage themselves, which essentially is what I think you were saying about Halma. So this guy was trying to be a little bit too hands-on, and he ended up getting the directors removed him pretty quickly. I think it was within a quarter or two. He was removed, and the stock went down from that as well. So maybe Halma, with a little bit of a dodgy CEO coming in, find someone better, get rid of him quickly. That might be your opportunity there, Steve.
It might be. I can't remember whether the Diploma guy was an outsider coming in or not. One of the things that... I mean, we're going to talk about Diploma in the future, probably, when we have a bit more time and a bit more space to do it, because both Steve and I have heard about this company, and we've been thinking about it quite a bit. And I'm pretty sure it's on both our watch lists, if I'm right about yours, Steve. Yep.
You are, yeah.
So it's a company we have a lot of time for, and you're not wrong in thinking that I think of Halma as very similar. There are differences in that Halma's a manufacturer and Diploma's a distributor. But, the wrong CEO... Interesting idea, that, isn't it? That the wrong CEO might be no bad thing. I feel like with a decentralised organisation like that, I sort of wonder what the CEO does. And I sort of don't really mind if the answer is nothing, to be honest. If it's just a case of sourcing acquisition targets or something like that, then maybe. But, that would be nice. Something to just bring that price down a bit more for me. And I won't miss it this time, I promise. I'll sell something if I have to go and buy it.
Are they doing any buybacks, Steve? That was the other thing I looked at.
No, so they don't check the standard value investing screener pillar thingamy on that. Their share count has been very, very flat and just slightly snuck up over the last couple of years or so. So, no, share count's not going down from what I can see of it.
Well, that's a good thing as well, though. So I suppose at least they're using their cash to acquire things, I suppose, not rather than not doing an awful lot of stock deals or wasting it on buybacks and dividends while they still want to grow. So I guess that's a positive.
Yeah, this is true. I was thinking about cash deals versus stock deals a little bit lately, actually. And when I look at sort of share dilution, and we've always said there's the good and the bad of share dilution, right? If diluting your stock down makes it more profitable per share, do it. If it doesn't do it, then don't do it. And basically it comes down to that in a certain way. And when I think about companies that I'm looking at and I am watching rather than owning for the moment, and I think, okay, you have to, I don't know, pay a bill or make an acquisition or something. Do I want you to do it through cash or through stock? I'm sort of torn if I don't own them. I kind of think, well, with debt, supposing they do it through debt, rather than like cash in the books already. I kind of think, well, look, if you do it with debt, that's going to be my issue going forward. basically. We're going to have to pay that debt off sometime in the future, and it's going to be while I'm a shareholder. If you do it with stock, I don't mind buying the thing after you've diluted it down, because the effect of the dilution is kind of done. Assuming you don't go and dilute me further on this story. So the issue with dilution, I guess, is they might do it again. The issue with debt is it's going to be there when I'm a shareholder and I have to work out how to pay it back, basically.
I just had a quick look at the analysts' recommendations as well. They're pretty split. So there's 4 in strong buy, 3 in buy, so 7 in the buy category. In the hold and the underperform, there is also 7. So although they have an average price, if you divvy it up, of the 14 price targets of 25 quid, well over 25 quid. So they're neither bullish nor bearish on it, but they think that there's another sort of 20% in the price to come.
Yeah, that's actually pretty good for a FTSE 100 thing, right? FTSE 100 doesn't do 20 quid in a decade, 20%, sorry, in a decade usually. 25 quid is a little higher than I'd be looking for here, but I'm interested in that as a. It's roughly where the stock, as you said, 20% short of that right at the moment.
Yeah, somebody thinks 33 quid just for the record.
So that person thinks interest rates are going back down, and I heard the Bank of England today saying, we will do whatever it takes to fight inflation. So I don't see that coming up. And these price targets are 1 year price targets, right? Or that's what they're supposed to be.
These are actually taken up to 2024, so there may be a couple of years.
No idea what's happening then.